Which one?
Sir, I think you've marked me absent.
Daksh Lohia. Yeah, Daksh, you're there. You were there in the
Daksh
last
Lohia.
this thing also?
No, sir, I was
No,
never
no, not. I
present,
mean, the
sir. I
last
was not
course
on
which I did,
campus for the
the
entire week.
corporate sector, this thing, taxation. Yeah. So Daksh, tell me which
Yeah,
company
yeah,
we are now,
taxation,
what
yes, sir.
company you can see on the screen? Which company you can see on the screen now, screener, which has
Sorry?
displayed? Yeah, Ultratech. Now, Ultratech is
Ultratech
which
Cement.
company? What is the company doing?
So they
Absolutely.
make
So this is
cement
the
for
biggest
housing
cement
and
company in
infrastructure
India.
buildings.
Okay. This is, if you look for the company, Ultratech is the biggest cement company. Now, which are the other cement companies there? So these are the list of all the other companies. So Daksh, can you read all the companies?
Yes, sir. So there's Grasim means Ambuja Cement, Shri Cement, JK Cement,
ACC.
Damia
So
Bharat,
there are about
and
seven
AACC.
companies which have been listed. Ultratech, Grasim, Ambuja, Shri Cement, JK Cement, Dalmia Bharat, ACC. Okay. Now, Grasim Industry is basically owns Ultratech. Okay. Ultratech is a Birla company and Grasim Industry is a holding company of Ultratech. Okay, fine. So Grasim Industry is not manufacturing cement, but they're all cement companies because Grasim Industry holds about almost 56% of Ultratech. Fine. So let's go back to Ultratech. So this is Ultratech. Okay. Now, so the topic which we are doing understanding is called valuation. Okay. Now, why we are studying a topic called valuation is because whenever the companies are raising money through an IPO or an FPO, so they have to they take the help of merchant bankers. Okay, to price the shares at what price they should offer their shares to the public. Okay. So now an existing company which is already there, which has already an IPO, now they're coming for further raising of money through a process in FPO. So they are going to have new shares coming into their company. So they can't offer the shares at the same face value. So what is the face value of Ultratech? 10 rupee. Can you see this? 10 rupees. So this is the face value of Ultratech. So that means the 10 rupee share is today trading at what price? 12,610. Isn't it? So now, can the new shareholders be offered share at 10 rupees? Say yes or no, Daksh. So they need the company need to charge premium,
No, sir.
from the new prospective shareholders who are going to join the company. Okay. Now the price is given here 12,610. Now company can say, okay, we will issue the shares at say 12,600 rupees. Fine. If now can they do that, Daksh?
So I think the FPO price is usually lower than the market price.
Absolutely, you're
Otherwise, there's
absolutely
no
right.
incentive for
The
investors
current
to buy
market
the
price,
FPO price.
the share price which is being offered to the public would be slightly lower than the current price normally. But I mean, of course, the current price which is given in the market is not the real price because sometimes the markets are, too optimistic about the future. Sometimes they are too pessimistic about the future. So share prices which are prevailing on the stock exchange may not be the right price. Okay. So we need to calculate a price which is called the intrinsic value price of the company, the real worth of the company. Okay. Fine. So that is a valuation mechanism through which we can calculate the real value of the company. Okay. And it is called the intrinsic valuation. So normally the merchant bankers, they will help the company to find out what should be the real worth of the company or what should be the intrinsic valuation. So if the shares are being offered below the intrinsic valuation, the shareholders, the new people will go and buy, because it's not the price which is prevailing on the stock exchange, but what is the intrinsic value, the real worth of the price. Now the intrinsic valuation can be lower and higher than the current market price. If the whole of the market is down, suppose there is a 20% or 10% correction which happens say in this month, so prices are going to go much below than it should be. So company can't offer a discount to already the share prices when they're low, and they'll never come up with an IPO during bad times. So when the share prices have already made a correction of 10 to 20%. So if it happens, the companies will remain restrained from raising capital at that time. So the merchant bankers are going to advise, what should be the right price? What price should they charge from the public for raising money? And it is called the intrinsic price, either the price will be lower than the intrinsic price because then the company need to collect money from the investors. So they will be only happy when they get the price slightly below the what should be the right price of the company. Now, so there are two mechanisms through which we calculate the price of the company. Okay. So one is called the relative valuation, of course, which doesn't throw up intrinsic value, but it tells you know how what should be the price of the company. Okay. It compares the current price and calculate what should be the real price of the company. Okay. So we are understanding the relative valuation, and later on we may understand some discounted cash flow valuation, which is called the intrinsic value. Okay. Now, so this price is 12. Now, how do we do it? If you have gone through my first video, which I've shared, so please, Daksh, have you gone through my video, which I've shared?
No,
Okay,
sir,
so do
but
you
I can
understand? Okay,
explain
very good.
DCF
So
and relative
now,
value to
at
you.
what is the stock PE ratio here? What is the stock PE of this company? How much?
53.6.
53.
53.6.
53.6. So what does it mean?
Yeah.
I mean, what mean to you? 53.6 is what?
So it means that the stock is trading at multiple of its earnings per share. So that means for every rupee that you buy the share for, there is like 153rd amount
So
of
what is the formula
profit
for
that they
PE
booked
ratio?
for the last year. So it's
So
priced
can you
by
see the two
earnings per share.
share price and earning share? How much is the share price? Oh, no, I think your voice is
12,610.
cracking. Srishti, are you there? What is the current price
Yes, sir.
and what is the EPS here?
Current price is 12,610 rupees.
Okay, so you can always
The
go to the
EPS
profit loss
is
account and know the EPS,
235
which is
rupees.
given at the bottom here. So EPS is how much? 235. Can you see that? So this is coming here in the chart in the this thing
Yes, sir.
235. Okay. So divide this 12,600 divided by 235. What do you get? So let's do that calculator. So, 12,000. How much was the price? 600, isn't it? 12,610 it was, okay, and 235. 12,610 and 235, okay. So when we divide this by this, we get how much? 53.65. Is that okay? So this is basically, we say this is market price per
Yes,
share
Yes,
sir.
and
sir.
this is earning per share, okay, EPS. Fine. And then if we just write a line here, so we get 12,600 divided by 235, we get 53. Okay. Now we can also calculate this number by another way. Okay. Which is looking at the market cap. 3,71,480. 3,71,580. 3 lakh 70. How much was it? 3 lakh? 3,71,580. Okay. 3,71,580. Is that okay? 3,71,580. So instead of taking the market price, we have taken the market cap. Okay. Here we'll take the income of the company, net income. Okay. So what I'll do is that I'll just, cut from here and put it one below and put the name of the thing. Okay. So here it will be basically the market cap. So this is market cap, and this is market cap. Market cap. Okay. Here I'll take the income, the profit of the company. Okay. Fine. Because market cap is what? The market price multiplied by shares, and income is what? The EPS is what? Income divided by the number of shares. We get the EPS. So we take the full number here, okay, income. And we go back to the here and go to the net income of the company. So what is the net profit of the company? 6,884. Okay. So I just plug in 6,884. 6,884. Okay. And then again, I do the same division. I should ideally get the same number. So I get 53.97. Am I getting the same almost? Okay, so there's slightly difference. So I'll tell you why the difference is coming,
Yes,
but
sir.
that will be for later point, because I'm going to explain why sometimes the differences come. Okay, because then we take the net profit for the profit for P ratio we should take, which is 6,085. We have taken 640, so that's the difference. But we'll just understand that later. Okay, what is this? Okay, so where we were. Okay, so we are back to the chart. So we're just going to close now in a short time. So the P ratio is how much? Of Ultratech 53. Now, if you look at all the P ratio for all the comparable companies, the companies which are similar, they're all in, cement. So, because, all the companies should trade at a similar P ratios. Okay, fine. The P ratio is telling you the relationship of earning and profit, of the price and earning. Okay. So, because the companies which earn more will always be having a higher price. So, this is a very beautiful relation. The P ratio captures the relationship between the price and the earning. The companies which earn more will always have a higher price. Okay. So now Ultratech is trading at 53. Now, what is what is that Grasim trading at 33? What is Shri Cement trading at 73? So there are large gaps. What is the median P ratio? Srishti, what is the median P ratio of the cement companies? Okay. Now we always look at the median. We don't look at the
50.33.
average, because average can get distorted. Okay. So on a median basis, all the cement companies, they traded down a multiple of 50. So when we look at a P multiple of 50, so Ultratech is trading at 53. So is it expensive than the industry, or is it cheaper than the industry? What about Ambuja Cement? Is it cheaper than the
Expensive.
industry, or costlier than the industry? Okay. And what about Shri Cement
Cheaper.
and JK Cement,
Cement is expensive.
Dalmia Cement,
Expensive.
ACC? Now,
Cheaper.
this becomes basically a setting
Cheaper.
that now then we'll go further deep into it. But the P ratios, if the company is trading below the median P ratio of the industry, we say it is cheaper, and the companies which trade above the median, we say that they are slightly costlier compared to the average. Is it okay? So now the P ratios will tell you how the companies are trading. Are they expensive or are they cheaper? Now, for example, which is the company which is trading at the highest P ratio? Now, if the company is trading at a high
Shri
P
Cement.
ratio, it means two things. Either company is too overvalued. Company is overvalued. So don't buy it. If you have it, sell it, book profits, and come out of it. Okay. Or we can say the company has a great future. Company is going to do very well in future. Okay. So people are buying up, and this is commanding a higher P multiple. Company is trading at a higher valuation compared to the average company, because this company is totally stand out compared to the other companies, because it has a great future than rest of the pack. Okay. Fine. Have you got it? What I want to say? So I explain again. If the
Yes,
company
sir.
is trading at higher than the median P multiple, there can be two possibilities. Either the company is too overvalued, it is not worth it, don't buy it, because it has gone up because of the overvaluation. Okay. Or secondly, the company is valued more than the average cement company, because it has a great future, because its earning per share is going to grow at a much higher pace compared to the other companies. Okay. Now, which company is having the lowest PE ratio? So here, now low PE ratio means
ACC.
again the two things. Either the company is undervalued, it has this, it is going to grow, it is a good company, but it is undervalued. So go and buy it. It is available very cheap compared to the industry average. Or the company doesn't have any future, So company P ratio of 14 is lower than the average P multiple of the industry because the company deserves a low P ratio because the company doesn't have any growth prospects. Have you got it? So can you repeat, Risti, what does higher P
Yes,
ratio
sir.
and what does lower P ratio means? Can you explain? Yeah.
So higher P ratio is either two options. One is the company is overvalued, and the second option is the company has a good future and it has growth potential. That is why it's valued higher than other companies. And the same, like, it's opposite for undervalued. So if the P ratio is less than the median P ratio of the industry, the company is either undervalued or the company does not have a good future. So it's
Yeah.
being essentially
Yeah.
punished and given that
Absolutely.
low
Absolutely
P
right. Absolutely right. So
value.
yeah. Yeah. Anyone?
So, so does that mean that
It
can we
is
say
almost,
Ultratech cement is
at a
slightly
rightly value.
overvalued?
Now, to really understand, because that is the purpose what we are doing, and we will do it in a great deal in our coming lectures. Okay. So we are going to see all the parameters and find whether the Ultratech is rightly valued or slightly overvalued currently, because whatever explanation I have offered, it is slightly overvalued compared to the industry. That is absolutely right. But now, because we have to look into so many things before we draw any conclusion and whether people should buy Ultratech or not, ultimately, people, somebody will ask, should I buy Ultratech or should I buy, say, any other company, Ambuja Cements, okay, because it's trading at 33. Now, the answers are not very simple. It may require some further knowledge, which we are going to gain in my subsequent lectures. Okay, fine. So, at the moment, of course, Ultratech is costlier than the industry, so one should not buy it. But that is not the real, the answer here. So, we will dwell into further details in our my coming lectures, where we're going to do an exercise and find for yourself whether the company is undervalued or overvalued. So I'm just going to end up my lecture. I'm going to just tell you, share a screen, okay, which you people have to fill up, okay. Fine. In the coming class, it will carry 25 marks. It will be a group presentations, okay, some group of 3 people who are going to attempt in that. So I'm just going to share that, this thing. So can you Punjab University. Okay, so I'm just going to open an Excel sheet, okay, which I have already made. So I'm going to share that template, so which you people have to fill as the time progresses, which is basically here. Uh, so this is, a template which I'm showing. Can you see the template? So which are the companies there?
Yes, sir.
Company name, column,
Ultratech,
and then
Grasim,
the
Ambuja,
second column is
Shri,
what?
JK, Dalmia, and ACC.
Third column is what? Fourth column is what?
Price,
Enterprise value. So we'll talk
market
about
cap,
that. Then we have sales. Okay.
EV.
And then we have, the earnings, everything, EBIT, EBITDA, then price to book, price to sales, and then the P ratios. Okay. Fine. And then the median P. And then we talk about, then we go company by company like Ultratech. Okay. There will be a sheet which you have to make for Ultratech and say what is the price and what are the analysts. Now, despite Ultratech being costlier, as we said that there are 43 analysts which are tracking Ultratech, so their still view is 28 people say strong buy. You should buy it. Okay, so we'll understand why they are saying buy despite it is costlier compared to the average industry. Okay, fine. So this exercise you people are going to do, I'm going to share the template